Want to get into the stock market, but think you need a fortune to start? Think again. In this video, we're breaking down stock market basics and showing you how you can start investing with just $100. Whether you're a complete beginner or just looking for a simple way in, we'll cover everything from choosing your first stocks to making your money grow over time. Get ready to take that first step toward financial independence, starting today. Today, we will talk about stock market basics, how to start investing with just $100. So before we start, make sure to hit the like button and subscribe to my channel. 1. Why anyone can begin investing with just $100. The stock market might seem intimidating at first, a sprawling jungle filled with confusing terms, dramatic price movements, and countless strategies. But the reality is that you do not need a huge amount of cash to start investing. The days when you needed large sums of money or a phone call to a stockbroker to buy a few shares are long gone. Today, with smartphones, discount brokers, and fractional shares, you can become an investor with just $100 or even less. This democratization of investing means you no longer need to be rich or well-connected to grow your wealth over time. Small amounts, when regularly invested, can add up to substantial portfolios. Compound returns, dollar cost averaging, and discipline allow ordinary people to become financial winners. Importantly, starting small lets you learn the mechanics of investing without putting large amounts at risk. And this education can be worth more than the profits you earn in the first few months. So whether you're a student, a young professional, or someone who just wants to dip their toes in, you're in the perfect place to learn how you can start investing with just $100. 2. Why small investments matter. The power of compound interest and dollar cost averaging. Some people say $100 isn't enough to make a difference. But this view disregards two powerful financial principles: compound interest and dollar cost averaging. Compound interest is the process of earning returns not just on your initial investment, but also on the profits you previously earned. Over time, this snowball grows faster and faster, a phenomenon often called compounding. For example, if you were to invest $100 and it grows by an average of 10% per year, which is roughly the long-term average return of the S&P 500, you'd have about $260 after 10 years and nearly $673 after 20 years, without adding a single additional dollar. That might not seem huge at first, but it highlights a key principle. Starting small and staying invested lets your profits compound. 3. Setting your goals and risk tolerance. Making your plan. Before you put your first $100 into the market, it's crucial to be clear about your goals and risk tolerance. Are you investing to buy a home in 5 years, or are you thinking more long-term, 20 or 30 years down the road, for retirement or financial independence? Your goals will affect what you invest in and how much risk you can take. If you have a short time horizon, say you need the money in 2 years, you might opt for more stable assets, like blue-chip stocks or bond funds. But if you're investing for the long term, you can afford to be more aggressive and put a large portion into growth stocks or low-cost index funds. Your risk tolerance, how much market volatility you can handle without selling a panic, is also a key consideration. If you lose 20% of your portfolio and it makes you anxious or tempted to withdraw all your funds, you might be a more conservative investor. The trick is to find a balance, choosing a portfolio that lets you grow your money, while honoring your ability to stay the course through market fluctuations. 4. Where and how to start. Choosing a broker and setting up your account. Once you know your goals and risk tolerance, it's time to open a brokerage account. There are numerous online platforms, Robinhood, TD Ameritrade, Webull, and Fidelity, that allow you to buy and sell stocks with low or zero commission fees. All you need is your social security number, some form of identification, and a bank account to fund your trades. Some platforms even allow you to buy fractional shares, which means you can buy a piece of a stock instead of a whole share. That's perfect for investing with small amounts. For example, instead of needing over $500 to buy a single share of Tesla, you can invest just $5 or $10 and own a fraction of it. The account opening process typically involves choosing what kind of account you want: a standard brokerage account or a retirement account like a Roth IRA, and then verifying your identity. Once your account is funded, direct transfer from your bank, you're ready to start investing. 5. Types of assets to consider: individual stocks, index funds, ETFs. With your account set up and funded, you need to decide what you want to invest in. There are a few key options here. Individual stocks. If you buy a share of a company like Apple or Amazon, you become a tiny owner in that business. Individual stocks can outperform the market, but they come with greater risk. If the company performs badly, your investment drops. Index funds. An index fund simply replicates a market index, like the S&P 500, by owning all or a representative sample of its components. This lets you diversify instantly and match the overall market's return. Exchange-traded funds, ETFs or a hybrid. They trade on the stock market like a stock, but typically track an index, a sector, or a collection of assets. They are a convenient, low-cost way to diversify without needing to buy numerous separate stocks. For a beginner with $100, ETFs and index funds are often recommended. They carry lower risk, provide instant diversification, and typically come with tiny expense ratios. 6. Making your first trade. How to actually buy your first security. So you have your account opened, your funding is in, and you know what you want to buy. Here's how you execute your first trade. Search for the ticker. Type in the symbol of your chosen fund or stock in your brokerage's search bar. For example, for the S&P 500 fund from Vanguard, the ticker might be VOO. Select Buy. Once you're on the funds page, clicking Buy will bring up a form where you can select how much to invest. If you're buying a fraction of a share, you can enter a dollar amount instead of whole shares. Order type. A market order executes immediately at the current price. A limit order lets you buy only if the price drops to a certain level. Confirm. Review all the details, amount, order, total cost, then submit. Once your order executes, you become a shareholder in whatever you chose to buy. Your portfolio will show how much you own and how its value evolves over time. 7. Staying the course. Monitor, reinvest, and keep adding small amounts. Congratulations, you're now an investor. But investing is not a set-it-and-forget-it affair. To maximize your profits and learn from your choices, you should monitor. Check your portfolio's progress. Are your holdings growing, shrinking, staying flat? Reinvest. If you earn any dividends, payments companies sometimes make to shareholders, consider choosing automatic dividend reinvestment. That means buying more shares with your profits, letting compounding work faster. Add regularly. Whenever you have a bit more cash from your paycheck, a side hustle, or a gift, consider adding it to your portfolio. Consistent small deposits add up quickly. Stay the course. Market drops are normal. If your portfolio drops 10% or 20% during a downturn, resist the temptation to panic and sell. Remember, you're investing for the long term, not trying to time the market. 8. Small begins big, stick with it. Starting with $100 might seem tiny, but it's a powerful first step toward financial independence. Small amounts grow through discipline, patience, and compound returns. The key is not the amount you start with, but your ability to stay consistent and learn. Every great portfolio starts from a small deposit. Warren Buffett made his first investment at age 11, with just a handful of dollars, and from those tiny roots grew a multi-billion-dollar fortune. Your path to financial freedom starts the moment you buy your first stock or fund. Instead of worrying about whether you have too little to invest, focus on developing the habits, knowledge, and discipline that will serve you for a lifetime. Begin with $100, learn by doing, and watch your portfolio grow alongside your confidence. The future is yours, one small step at a time. If you like this video and would like to see more like it, please give it the thumbs up. Leave a comment and click the button to subscribe.